Hi, everyone. We're going to get started here in a minute or two. Just give everyone a chance to join the call.
I just hit return. So. Yeah. Oh, I'm good like this. Yeah. Oh, yeah.
Okay, everyone, we're going to get started. My name is Brad Blosser with the Core Group, and today's webinar is going to be on the power of index annuities. Those of you that are using variable annuities in the marketplace, I'd highly recommend you let us do a case design and compare it against index products. The index products of today are very, very client-centered. They'll go toe-to-toe with variable annuities, particularly on the income side. Market performance is basically a non-issue. Long-term care benefits, you would be doing your client a disservice if you did not compare your VA solution to see if there's any index alternatives out there. There are many, many index products out there, and like I said, they are extremely client-centered. Lincoln has fantastic products in this space. Some of the highest income guarantees out there with long-term care benefits, and it's my pleasure to introduce Anthony DiTullio.
Thanks, Brad. Good morning, everyone. This is Anthony DiTullio from Lincoln Financial, and I think we'll be together about 20 minutes today. And my goal is basically to educate and have a discussion around fixed index annuities and maybe how it's a really timely solution for your customers and the agents that you work with. One thing Brad pointed out, basically comparing an FIA to a VUL, and I would start by saying I wouldn't say that one's better or worse. They're different solutions for different clients depending on what the client's needs are. But my goal today is to highlight the benefits of the tool and talk about how an FIA can protect your clients in a down market while still letting them participate and the upside growth in an up market. Hopefully we'll have time for questions at the end. If you don't feel like asking a question at the end, you can always follow up with the core group or myself after the meeting, and be happy to help. So just to start off here, a couple things I want to discuss. So obviously reaching tomorrow's potential. So let's just talk about growth, right? All of your clients are probably finding themselves in a situation where they've saved a lot of money throughout their life, but they need that money to last. And if they can get some growth along the way, that's great. But the thing that's probably most important to them is protecting that nest egg, protecting the money that they've worked so hard to save. And they can't put that at risk, but they're also concerned with maybe outliving the assets they've accumulated. So they need a reasonable rate of return. We all know this story. It's not necessarily a new story, right? Protecting from downside risk and participating in the growth, but I think it's a very timely story with the way the stock market has been performing and our current political environment, etc. Sorry, they're having a little bit of technical difficulty. There we go. Okay, so reaching tomorrow's potential. It's obviously a pretty straightforward story. How do you plan to achieve your goals? Capital preservation, and that's what I touched on in the beginning. It's help protect your assets from risk. This isn't a situation where you're looking to be over-aggressive, be overextended. You've accumulated these assets, and now you want to protect them, but you want to get a better rate of return than you're finding in, say, a CD or some other investment opportunities out there. You want to help ensure that your portfolio produces the income that you need. A lot of the clients that you work with have accumulated these assets, but now they're focused on taking a stream of income, a guaranteed stream of income if at all possible. And today we're going to discuss how they can do that using a Lincoln fixed indexed annuity. So overcoming some of the challenges. Tax uncertainty. It is one of the biggest things that scares the clients we work with. You don't know what's going to happen with tax rates. I don't know what's going to happen with tax rates. But there's probably a pretty good chance that tax rates could increase. But at the end of the day, it doesn't matter because your clients are concerned about it. So if it's something that we can ease their concerns, it's a meaningful conversation to have with them. The risk of outliving your savings. We often talk about rate of return. During our accumulation years, what's the most important thing? Getting that high rate of return. But when we're in retirement and we're trying to live 20, 30 years off the nest egg, it's not necessarily the rate of return that's important, it's the sequence of those returns. So how can we use an FIA to smooth out that sequence of returns, giving your clients both the safety and the opportunity to accumulate even further? Inflation. Again, this goes back to outliving your assets. We know clients are concerned about inflation. They save this money. They need a reasonable rate of return to keep up and hopefully exceed inflation. And market risk. Pretty obvious. Our clients know that they need a reasonable rate of return. They want to experience growth, but they want to avoid volatility any way they can and create that sustainable income. So we want to show today how an FIA can approach all of these concerns, these four major concerns that your clients are faced with each and every day in retirement. So we know that we're in a relatively low rate environment. In a low growth, low inflation world, rates could stay lower for longer. However, it's more about the uncertainty and how can we take away the uncertainty that our clients are facing. We also know that we're in an all-time high equity market. How long is that going to last? We've seen it go up and down, especially in the last 3 to 4 months. I think a lot of our clients, rightfully so, expect some sort of market correction. So how do we protect them in the event that that happens or when that happens? So overcoming some of the challenges that we outlined earlier in the discussion. So lock in some of your gains. We've had an 8-year bull market. What can we do to take those gains that your clients have already experienced in their non-qualified asset and lock that in for future use? How can we get higher returns and safety in today's low interest rate environment? We know that CDs, money markets, and savings accounts are offering them less than 1% return over the last 3 years. How can clients possibly keep up with inflation, cost of living, and other expenses they might face, never mind growing their assets? So I promise I'll keep this a bit light on the Lincoln product front, but we are having a lot of success with the Lincoln OptiBlend series because it addresses these concerns in a really simple, straightforward way. Let's think about the client that we're meeting with. A client that's early in their retirement, wants that safety, wants that growth potential, but it's not necessarily a financial whiz or an investment expert. They want something easy that they can understand, something that's going to protect them in the downside market, but allow them to participate in growth. So I think what you're going to find is the solution, it's simple, it delivers the most value to the client, and you've got the financial strength of Lincoln Financial, a company in business over 114 years. So we'll walk through exactly how OptiBlend can offer your clients a solution, but it's essentially the optimal blend of safety and growth, like you'd find in most fixed index annuities, greater earning potential than CDs, money market savings, tax-deferred growth opportunities, and we'll talk about why tax-deferred growth is so important. And then lastly, financial protection from market downturns. So again, it's going to blend safety and growth, the potential to create the income you need to enjoy years ahead, access to your money. It's a big thing to clients, right? Sure, they want to put their money in a safe spot where they'll have that opportunity to grow, but should life events occur where they need access to that money, whether it be helping a family member, an extra stream of income, or to Brad's point, long-term care, they want to be able to have access to the money should they need it. And a death benefit for their loved ones should they not use the annuity in their own lifetime. So when we look at investment options and the allocations inside the OptiBlend series, I want to keep it really simple. And I'm going to focus on two of our most popular index allocations. The S&P 500 index, a one-year point-to-point that we've all seen a million times, and then the S&P 500 daily risk control, which is something that is a bit unique to Lincoln, especially the way we have it included in the product, and I think can deliver some true value to your clients. So let's start with the S&P 500. It's the best barometer of the nation's largest cap equity market. It represents approximately 80% of the U.S. stock market, and it's many of the household names. Here are a few here: General Mills, Microsoft, Mattel. We're all very familiar with the one-year S&P 500 index. The thing I especially like about it is your clients know the S&P 500 index, right? S&P 500 is a household barometer of what is the stock market doing. So it's very easy to have that conversation with your clients. Hey, look, at the end of the year, we're going to see what the S&P 500 did. If it's up, you get to participate in some of that growth. If it's down, you're locked in at zero. So you're giving that safety net and protecting that sequence of returns that we alluded to earlier. Now, Lincoln also offers another allocation which we've had a lot of success with. When you think about accumulation to your clients, what is the most important number when accumulating assets? The obvious answer is rate of return. I would take that a step further. It's the rate to your client. What difference does it make if the S&P 500 does 10%, 12%, heck, even 8% if we're capping them at 6%? That's all growth that they're not participating in. With the S&P 500 daily risk control, we offer an uncapped option for your clients. Now, there is a spread. Currently, it's around 120 basis points. It's a one-year allocation. So really easy. Vol control, this risk control account, does 14%. You subtract 120 basis points, client gets over 12% credit to their account. At the same time, they've got that 0% downside. You're going to be hard-pressed to find an option in the industry that allows your clients to participate in the upside market more than this while still maintaining that downside protection. So when we look at it, OptiBlend is the chassis. OptiBlend is the FIA that we use. The daily risk control is the investment option inside this chassis that allows your clients to participate in upside potential really more than many or most options in the industry. Keep in mind, like many other FIAs, we allow clients to allocate across our options. So if you've got some clients that say, hey, I want to be in the fixed account for some of my money, I want to be in the S&P 500 for some of my money, and then this vol control for some of their money, they're able to do that. They're able to go back and forth. The only limitation is it's got to be at the end of the segment. So in this case, at the end of the one-year segment. Pretty straightforward. We want our clients to be tied to the growth, the green, the growth, and not tied to those down markets. 0% in those down markets. You think about it, you look at this graph right here. Anytime there's a down market, how many years would it take your clients to recover from that? Again, it is not a complex sales strategy. It's a really easy sales strategy, and that's why we call it the power of zero. Because in those down years, they've got zero. They're able to lock in previous year returns and then grow from there in the upside market, in the up years. So staying in control of your retirement. I think that's, when we work with clients, that's one of the biggest fears is losing control. Our clients don't have control of what the cost of living is going to be. Our clients don't have control of what tax rates are going to be. And frankly, they don't really necessarily have control of what the stock market's going to do. But we're giving them back a lot of that control by setting these parameters with the zero downside and letting them participate in upside potential, and then coupling that with guaranteed income options. So again, these are all forms of control that we're giving back to your client. They get to choose where to allocate their money. They get to make changes if their growth strategy changes. They get to feel assured knowing that their principal is protected. At the end of the day, that initial investment that they trusted Lincoln with, that they trusted you with, is protected. They never have to worry about losing money and taking money from that nest egg that they've worked so hard to grow. They never lose what they've earned. We know they're locking in their gains each and every year. And really important, we've touched upon this already, is they have access to the money, or they can take a stream of income depending on what their needs are. I touched upon this a little bit, but just so you have a sense, and the core group is here to help you as you navigate case design. And I think it's really important, Brad touched upon this, when you've got a case where you think that this is a fit, go ahead, run some numbers, look at the concept, and look at the product and the solution overall. You know, I'm always 50-50 with illustrations, because certainly we can tell the story we want to, but at the end of the day, it's the concept, it's the solution for your clients that not necessarily can be told all the time on an illustration. But you do have a few options. So you do have a 1-year fixed account for that client that says, hey, I want the safest possible option inside the chassis. It's not tied to market performance. It's guaranteed growth. It's got the 1-year point-to-point index account with a spread. That's that vol control that I talked about. So it's growth with volatility controlled, and most importantly, it's uncapped. Highest potential rate to the customer. You've got our 1-year performance triggered index account. Simply said, if the market is at 0 or up at all, your clients are going to get about a 4% return. If the market's down, they're protected from that downside performance. And one of our most popular that we've touched upon already, the 1-year point-to-point index with a cap. So I would say when you're looking at the OptiBlend series, the 2 allocations that we've had the most success with are that vol control uncapped option and the 1-year S&P point-to-point with a cap. So let's talk a little bit about the power of growth with tax deferral over taxable or tax deferred after taxes on an asset. Really straightforward graph here. Clients investing $100,000. Well, that's taxable over 20 years. It's going to grow to about $223,000 with historical market returns. If we're able to do tax deferral after taxes, you got about $255,000 of performance. But if we're able to give them true tax deferred growth, look at the impact of that. Their performance is up over 50% as opposed to an asset that they would have paid taxes all along the way. We all know this story. We're not going to be able to avoid taxes, right? We've got to pay taxes somewhere along the way. But if we can defer that during those growing years, that makes that asset growth all that much more important and all that much stronger. So Brad touched upon this at the beginning of the presentation. I think it's really important. Get income when you need it, how you want it. So we do offer a free withdrawal, 10% of your contract value each year, starting year 1 without charge. And that's really important because that 10% free withdrawal is available even when a client does elect an income rider. I would say the majority of our cases do have an income rider, but regardless, your clients always have access to 10% of their contract value without any charge beginning in year 1. You will see some other carriers defer that until year 2. We allow it right from the get-go. Clients they're able to annuitize, like many other FIAs. The ability to receive income payments for life. And that's the key. And then we've got 2 options, and I'll discuss those. But the fact that they can have income for life, it's basically their own personal pension plan, is really important. And then a safety net if something unexpected should happen, something like a long-term care need. We know many of our clients are one long-term care event away from being in a really tough financial spot. And we know about 80% of folks over the age of 65 are going to have some sort of long-term care need. So we want to make sure we protect them in the event that that happens. And then a death benefit should they not use the annuity in their own lifetime. So there's two primary income options that we have on the OptiBlend. And hopefully we'll be able to do a follow-up discussion specifically on these income riders. I know Brad and his team here are experts with them, but this is really kind of the Lincoln difference. The first is our Income for Life rider, which is an income now rider, in the sense that the client has got to begin taking income within the first year. So sometime within the first 12 months, clients got to begin taking income. That income amount and duration is guaranteed, the duration for life. So your client is going to know for the rest of their life, they are going to get this amount. They still have access to their principal, that 10% penalty-free withdrawal, and they still have protection to their beneficiaries. Now, for the client that says, I know at some point I'm going to want income, but it's not going to be for a while. It could be 5 years from now, 10 years from now. Well, then you want to look at our Lincoln Lifetime Edge rider. Guaranteed growth. The key here is a bonus if you delay taking income. So if you delay taking income for 5 years, we give you one bonus, 75 basis points. If you delay taking income for 10 years, you get over 100 basis points to your income base. So clients are rewarded for delaying that income stream. And as Brad mentioned, we do offer nursing home enhancement. Now, one thing I want to point out about the Edge rider specifically, you can add it post-issue. And that's really important for two reasons. Think about the client that you meet with that's unsure if they're going to want income. So they don't want to incur the charge of an income rider right off the bat that's going to drag down the performance of their allocation for a rider they may never use. They'd rather wait and see, hey, 4 or 5 years down the road, if I want to add the rider, I can do that and start getting the rider charge at that point in time. The second situation is a client that you meet with that says, I don't think I'm ever going to want income. I don't even want to discuss income. But for whatever reason, once they've got the annuity, their needs have changed. And now they have a real need for guaranteed lifetime income. Well, you now have the assurance that you can add that for them at any point in time. So I think that adds a lot of flexibility to the solution. But again, we're giving clients back the control to control their situation should their income needs change. A couple more things I want to touch upon before we open it up to questions. I mentioned the I for Life rider, and I don't want to get too into the weeds on this call, but this is certainly something you should consider when looking at income riders. Again, this is the somewhat immediate income solution. This is the income now solution. But because of that, we're able to take advantage of the exclusion ratio. So you'll notice the situation that we give, almost $14,000 of income is received to the client each and every year. But in this situation, only the gains are taxable. That's very unique with an indexed annuity. Usually we only find that with a SPIA. So in this situation, only around $4,500 would be taxable, with the remaining $9,500 being non-taxable income. That's tremendous. That's a true differentiator in the market. Maybe it's one of the follow-up pieces we'll include this. This is a patented solution for Lincoln. White paper, IRS code, no other carrier can offer this type of income stream in a fixed indexed annuity. So again, for that client that wants income now, but more importantly, wants tax efficiency in their income from an annuity. The I for Life rider is a great solution. The conversation with your client is not, hey, let me tell you about Lincoln's I for Life. The conversation with your client is, what if I can show you a way where you've got downside protection in down years in the market? I can show you growth potential using that uncapped vol control index that we talked about. And I can show you the most tax efficient way to get guaranteed income for the rest of your life. If that's something they're interested in, you can work with the team at Core to do an illustration and show how the mechanics of opt-to-blend with I for Life would work. Lincoln Lifetime Edge is a little bit different in the sense that I said it is for that later income. It's not right away. So this rider is actually changing a bit in the next couple of weeks. It's actually going to change from 5% to 7% simple return. So you know your client at the very least is going to have their income base grow by 7% each and every year. We'll be rolling that out next week, and we'll have some more details for you on that. A bonus if you delay taking income. I had mentioned 5 and 10 years are the two hurdles, so to speak, the two bogeys for the clients to hit. And then nursing home enhancement. I think this is so important. I think when discussing any financial tool, whether it be life insurance, a hybrid product, annuities, we've got to be talking about long-term care. Your clients know they have this need, they're concerned about it, but nobody's talking to them about it. So if you're able to give them protection to their investment, some sort of lifetime income, and protect them from nursing home, that's a tremendous value add that you're adding for your clients. Just real quick, I know we've talked a bit about Lincoln products, and I think at this point most of the people on the call are familiar with us as a company. We are a household name, but there is comfort in the fact that we've been around over 114 years, A-rated carrier, 5-to-1 asset to liability ratio. You can feel secure using a Lincoln fixed indexed annuity for your clients, because at the end of the day, this is a safety sale. This is about protecting your clients' assets. And that protection is only as good as the carrier that's making those promises. So with that, I'll open it up to questions. I don't know if that's a button I need to hit on my end or something you can do to open up to questions, but happy to take any questions here. And if you don't have a question now, but you think you might later on, just let me know.
Thank you, Anthony. It doesn't look like there are any questions. Folks that are on this call, if you have any questions or if you have any cases that you want to speak to us about, be sure and give us a call. We'll be happy to help you compare your situation with what's out in the marketplace today. Thanks again, Anthony.
Well, if we don't have any questions, I thank everyone for their time. Again, please feel free to reach out to the team at Core with any questions, and we look forward to following up. And everyone, I wish you a successful, happy, and healthy year. Take care.